Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. Since the last time we met, two of the three major indices have set new all-time highs. A lot of what influenced the stock markets, of course, over the past 2 years has been inflation and interest rates. Well, inflation has been falling and interest rates have been holding steady. But the stand on interest rates could soon be changing when the Federal Reserve meets this week. And just how broad-based is the rally we've seen? Also, we are in a new year. Perhaps you've decided this is the time to seek some professional advice on investing. But how do you choose an advisor? Well, that is part of the discussion in this week's edition of Around the Table with Stacy Smith. And here to discuss the topics and more are our panel of financial advisors and analysts. And let me introduce them to you now. First up is Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. Carrie has been recognized by Forbes as one of the top women wealth advisors in the country. Also seated at the table is Frank Rossetti. Frank is the managing director of HF Management Company, which is part of an alternative asset partnership. Frank's background includes 50 years in the investing field, and he helped to establish Harvest Financial, which is based here in Pittsburgh, where he was the executive chairman. Across the table, we find Kim Forrest. Kim is the Chief Investment Officer and the founder of Boca Capital Partners. Kim has a dual background in both software engineering and in finance. And you may have seen Kim in her many appearances on CNBC, Fox Business, and also on Bloomberg. And there's one more seat at the table, and that is where we find Michael Godwin with Fergasso Advisors. Michael has a solid career in investing and is the Chief Investment Officer for Fergasso. And again this year, Fergasso Advisors is listed among Barron's National Top 100 Independent Advisors. Thank all of you for joining me once again for Around the Table with Stacy Smith. And I say let's go ahead and get right into what we're going to talk about. In the last quarter of 2023, the stock market surged ahead, partially fueled by the belief that the Fed will soon be lowering interest rates and that the latest economic news indicates inflation is at or near the Fed's target. So, Michael, will the Fed give the market what it wants to see on this Wednesday, or will it wait to see the latest jobs numbers, which are due out on Friday?
Yeah, thanks, Stacy. So it's pretty much a virtual certainty that the Fed will leave rates unchanged at this week's meeting. I mean, the jobs numbers here in the U.S. have been very strong, with the unemployment rate still below 4%. In fact, I was looking at this morning. If the unemployment rate remains roughly where it is over the next 2 months, which I have no reason to believe it won't, this will be the longest period of sub 4% unemployment since the mid-1960s. So that, coupled with inflation that's still above the Fed's target, is why I think the Fed is going to leave rates unchanged this week. What investors should pay attention to is the Fed's language surrounding future interest rate moves, okay? The markets are currently pricing in a 50% chance of a rate cut in their March meeting. Now, I think most investors would probably question as to, why would the Fed cut interest rates at a time when inflation is still higher than desired and the economy's, near full employment? If you look back at prior Fed rate cut cycles, typically they cut interest rates to spur demand. And that generally happens during a recession with the unemployment rate much higher and when people have essentially stopped spending money. And we're clearly not in that situation right now. I mean, I just discussed the employment scenario, but consumer spending, Stacy, has been very robust over the past 4 or 5 months, even with those higher inflation numbers. And you mentioned that the inflation is coming back down. You're right. I mean, it's really been moving in the right direction. It's now below 3%. And if that trend continues, you'll get to a point where short-term interest rates, which the Fed controls, is at 5.5%, and inflation might be closer to 2.5%. And that's a very wide gap that will eventually hinder economic growth. I think that's really the reason why the Fed may cut rates in March or in May. But my biggest concern is if they do that, then you might see a reacceleration of inflation. And that might not happen all at once, but I think that's probably going to be the biggest concern of the Feds and ultimately the economy.
What you had to say, Stacy, about employment is a key factor to that. If in fact the Fed starts seriously thinking about it, and they indicate that, I think the employment numbers will have a lot to do with it. Simply because as long as we have this shortage of workers, it's going to be more difficult for them to be comfortable that once they start cutting rates, we won't have inflation, because today wages have kept pace with inflation, with not in a straight line, not tick for tick with it. But after the 2 years of all this, they are pretty much caught up. So people have the money they need to keep spending. And as long as we have a tight employment picture the way we have now, it's going to be difficult for the Fed to cut rates much, because they will have a fear that inflation will come back because people are working so well.
Let me, I want to
quite
go
a
ahead.
dilemma, actually.
I want to touch on something that Michael just talked about. If inflation is coming down, but has not necessarily reached the Fed's target rate, and interest rates are still this much higher, that really affects businesses in how they are going to be able to borrow money or refinance loans that they might have. And they're going to be paying more than maybe what they should be. Is that part of the argument that people want to see these rates come down?
Yeah, typically the Fed cuts rates. Historically, the Fed cuts rates as unemployment is going up. And I think the argument to do it sooner rather than later is to prevent that really from happening. And you're 100% right. If rates are up here and inflation's down here, that ends up hindering economic growth. So the argument goes, let's try to get ahead of the curve a little bit and start cutting interest rates. My one comment on what Frank mentioned was, yeah, wage inflation has kind of kept pace with overall inflation, which is great. The only problem with that is you have 65 million Americans who are retired, and those people could be hurt with an accelerating inflation. I know Kim has a few things to talk about regarding that stuff.
So it's not the, okay, let me start, because I'm so excited to talk about stuff like this. So first of all, where does inflation come from? Like, we're kind of assuming the Keynesian view of this is that growth equals inflation. And if we look at like 2012 through 2019, we had kind of good growth and we had absolutely no inflation. So I think the Fed and economists in general have to go back to rethinking where inflation comes from. So that's thing number one. Thing number two is, I think some of this, we forget that the Federal Reserve is the Federal Reserve Bank that is actually owned by banks, right? And I think part of the pressure that businesses are feeling or beginning to feel is the high rate of borrowing. Now, whenever the talk in the end of this last year came to be that the Fed might cut, we saw an enormous jump in mergers and acquisitions being announced. And why is that? Well, I think businesses can see their way, that see the path to lower interest rates. And even if they do an acquisition now, they can in the future refinance. And this could impact the mortgage area as well, because again, homeowners are pretty savvy. They've now figured out, like, it's not one mortgage for me, even if I don't move. People know about the magic of refinancing. So I think the Fed lowering rates before the economy collapses for whatever reason is probably good in this instance, because it doesn't look like growth equals inflation.
Okay,
Go
Carrie,
ahead.
Yeah, Carrie,
Tell me where I'm wrong.
if you can wrap it up for us very quickly here.
Well, one thing I kind of don't agree with this conversation are comments that the employment market is really strong, because one of the factors that we look at are the number of job openings to available workers, which peaked in March of 2022 at about 2 jobs for every 1 person, about 12 million jobs available. We are down to about 8.7 million, which is about 1.4 jobs to every worker. So the labor market is not as lucrative as it was. And I think that will help to keep wages under control. And even last week, some of the weekly unemployment data that we get showed some signs that, maybe a little weaker than expected. It's the first time we've had that. So I would say keep an eye on employment.
Okay, we need to take a break, and we'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. So let's say this. I'll pose this question to both Carrie and to Frank. I have some money that I want to invest. I've never used a financial advisor of any kind. So how do I go about choosing an advisor? Carrie, your thoughts first.
Well, the first thing I would say is find someone that you know, that you respect, and ask them if they have any recommendations. I know in my business, and I'm sure in a lot of the other advisors around this table, most of our business comes from referral. So this is one time you don't want to just, do a Google search and say, who should I call? The other thing is that you really have to consider, when you want to invest, that there are other areas of your wealth and finances that are directly impacted, like your taxes. Also, when you have wealth, you have to start to consider what happens if I die. So looking for someone that's credentialed in all areas of financial planning really makes a lot of sense. And the gold standard in this industry is the Certified Financial Planner, the CFP designation.
All right. Well, there's CFP, and a lot of people have a lot of other little initials after their name as well. Are those other letters important as well?
I think it's really important to know what they mean and what they stand for, and really matching up what your needs are to someone that's credentialed. And there definitely are some other really good credentials out there in terms of financial planning. Michael can talk about the CFA designation and what that means. And what I would say to someone is that if you are solely looking for someone to invest your money, you don't care about, or you have your taxes under control and you feel that you're in good shape, CFA is probably the gold standard when it comes to an analyst position and actually picking companies. So, pay attention to designations. Because it really will give you some background as to what that person is credentialed to do.
So let's just say, I'm going to, and everybody else can jump in as well, but let's just say that we take the scenario I presented. I have some money. Now, we'll maybe get into how much money you need before you start to seek a financial advisor, but so I have some money. So I want to look first for the CFP, somebody who's a planner. Is that right? Let's just say I'm somewhere between the ages of 25 and 35 or 40. Anybody else want to
Sure.
jump in?
I think there's a couple of things on that, Stacy, and let's just say that also, to Carrie's point, going to somebody that you respect and trust and getting a referral for them, that we get most of our business that way as well. That's the absolute number one way to do it, I think. But if you don't have that, and you don't feel comfortable asking somebody, who do you use and whatnot. I think there's a couple of things that are very important there. One, if you're going about it like a Google search or something, interview as many people in firms as you can, right? Don't just pick one and go with that boat. I think at the very end of the day, trust is the number one thing you have to feel when you're talking to a financial advisor or financial planner, what have you. Do you trust them, and are they going to do right by you? Carrie mentioned the CFP. They are fiduciary advisors, meaning they have to put your interest at first. That's an RIA firm, which is what I am, and Carrie is as well. They are fiduciary advisors. They put your needs ahead of their own personal needs. So that's very, very important. I'm a CFA, so I have an analytical background. I do a lot in terms of the analysis of stocks and markets and whatnot. We also have CFPs at the firm. I think this is a very important thing too, where we delineate the responsibilities at my firm, where certain people are financial planners. They help with the planning aspect, and certain people do the analytical work where we build the portfolios for you. It's very, very hard to do both of those simultaneously as an advisor to a client. Very hard to do all the planning stuff and all the advisory work. So one of the things I'd also look at is the structure of the firm you may be interviewing with.
All that being said, I think all these ideas are absolutely important, and they're right. They're the things that you may need to think about. But before you start on this mission, I would advise you to determine exactly what it is you want. As Carrie alluded to, there are people out there who have no interest in all this. They have their own lawyers, their own CPAs, and their own advisors that help them with their wills, estates, and trusts, and all those other issues and taxes. And you may only want someone to bounce your ideas off of, and then decide what it is you're going to buy or not buy, invest in. And That being said, the old-fashioned broker-dealer is the answer to that, not the IA and all that, where the fees are asset-based or hourly-based. There's many ways people are doing it these days. And it's transaction-based on that way. So you're getting that guy's or person's ideas and deciding whether you like them or not and saying yes or no, and you're taking it on yourself. So first thing you need to do is, what do you want? I've had clients when I worked that wanted me to do everything. I had clients who wanted me just to call them when I had an idea. All right. And that being said, you need to know what it is you want.
And I agree. I agree with what just about everybody has said here, but I think you need to know what you're looking for. How much help do you need? And to find that person and make sure, this is mathy Kim, make sure that how they're compensated matches the value that you're going to get out of them. And if you need comprehensive, like, I'm just going to shove all my information at you, paying on at a broker dealer for stock picks is not a good way to get what you're going to get, right? Or your needs are not going to be met, and neither is the value going to be given to you. So you have to understand what your needs are and how that lines up with how the people that you're getting advice from are paid.
All right, we need to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. And right now we're focusing on the fact that you want to choose a financial advisor of some sort. We've gone through some of what we need to know. But Frank, you mentioned about fees. Is that something that is important, and how a client would take a look at those in choosing a financial advisor?
Yeah, I think you need to know how this person that you're going to engage is going to get paid. Understand that if it's a transaction situation, that incorporates a conflict of interest that a fee-only advisor does not have. It also, on a fee-only advisor where they're dealing with no-load funds, offers you an opportunity to, in theory, easily talked about, difficult to attain, get the best of breed, if you will, if you're buying mutual funds or whatever. I mean, it's the problem with the best of breeds. If you line up the last set of Barron's greatest mutual funds, the list is never the same from year to year. So I'm not sure it's easy to come up with best of breed. But and after 52 years of doing this, I'm still not sure it's easy to come up with what is actually the best fund in whatever category you're looking at. But all of these things have costs, and you're going to pay that person somehow. So what you need to do is figure out how that is, and is the conflict of interest that fee structure, commission structure, because they're all conflicts, all right? If that conflict of interest is something that works in your favor or against you, and that's pretty much it, because conflicts, for everybody at this table, the only conflict we've had is the fact that we're going to charge you one way or another. And that being said, be careful when you go with the very big firms. They have all kinds of, read those disclosures. They tell you what their conflicts are. It's required now. And you determine whether you can live with those conflicts.
Okay, let me interrupt you. Let me interrupt you. And everybody can jump in, or anybody can jump in on this. What do you mean by conflicts with
where there are other business interests? For example, I'm not going to name any firms, but the big magical wirehouse in the sky, all right? They do underwriting, they do research, they do mergers and acquisitions, they do all these things, and all these things are profit generators for them. And then their advisors are out recommending assets that they may be merging, and they get a research recommendation. Can you be certain that that recommendation is driven by the facts of that asset, or by the fact that they're going to merge with XYZ and they don't want to lose the customer? All right. Now, they work hard at keeping that from happening, but it's an imperfect system and there's nothing they can do about it. It just is. And you have to be careful. Now, the person you're dealing with doesn't have this conflict. His firm does. And now with this hyper regulatory environment that we all live in, you have to sit and talk about why and everything you do is in the best interest of the client. Now that helps with that. But a lot of this information that the advisor is using to come up with what's in your best interest is driven by information given to them by Big Brother in the sky if you work for a large firm. And if that firm is doing more than just dealing with clients, as the firm we sold to is, only with clients, as I know everyone else at this table is, only dealing with clients, all right? And if you're doing more than that, you have a conflict, that person has a conflict of interest. It may be minor, it may be something you want.
So Carrie,
You
let me
know what it is.
Carrie, let me throw this question to you after listening to what both Frank and Michael had to say here. I have no idea whether your firm uses a was it CFA? I guess it is. That's Michael's 3 letters, I guess. Whether you use that, or do smaller firms such as people here at the table have, as opposed to the huge firms that advertise nationally? Do you all go to a same source for some of this information? Do you have CFAs in your workshop? And should you go to an advisor or a firm that does have their own CFA?
Well, I think that you want to understand what the credentials of the person that is actually doing the due diligence, what those credentials are. So at our firm, we don't have a CFA on staff. However, our broker dealer has 32 people that we rely on every day that are CFAs, CMO, which is an investment management designation. And I'm happy to say that Kim, for instance, across the table, we utilize her services in picking some of our stocks. So, you know, what we're doing is we're marrying the expertise of CFAs and CMAs with what we believe is going on in the global macro environment. Because one of the things, you know, there's a disconnect there, right? Because in my experience in dealing with a lot of analysts, they're concerned about their company. You know, I cover a stock, this is what I'm concerned about. Where if it's, let's say it's a retail company, they might love their company, but if I think the consumer's slowing down, I might not want to go there. So there's a marrying of those two things. And when it comes to fees, you know, I find it really interesting, right? Because the 2 most important things they say that people worry about the most are their health and their money. I'm telling you, I'm not going to find the cheapest doctor. So when people want to just do a fee comparison, well, you charge this and this firm charges that. I'm like, is that really what you want? You want the lowest possible fee, because lowest possible fee may mean lowest possible service. And all of our firms have a variety of different services. You know, someone might charge a fee, but does that include then actually doing a retirement plan or a college education plan? What's included in that? And then you also have to look at trading costs. So one thing that we've done at our firm is, you know, we charge a flat fee that includes all of our wealth management services, all of our investment management services, and all of our trading fees. So everyone operates a little bit different. It does take some effort, you know, and you have to know the questions to ask.
Maybe that's one for another topic, another subject, or another edition of Around the Table, because we're run out of time for this segment. I'm going to make some notes on that. I'd like to continue this at another time, because I find it fascinating. And you know, what question comes to mind? Well, what is a legitimate fee, or what is you know, who knows? I mean, if you're new going into this, that you just don't know. All right, I said we need to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. We've talked about how to choose an advisor. We've talked about whether interest rates are going up. We've also said that the S&P 500 set new record highs, mainly on the back of the tech sector. In fact, the other 10 sectors of the index are trading below their all-time highs. So, Kim, the question for you. You choose stocks for people to invest in. Is this a problem that only one sector is going up?
Not really. We're looking at a point of time where,
Let me interrupt. I shouldn't say
Oh.
only one sector going up. The other sectors are going up as well, but not as much as the tech sector, if that makes sense.
right, right. Well, some of the things that I've learned from being in this industry for 25 years, it's really simple. Growth pays. Investors are looking for growth. And in the last, 22 was just a hot mess. If you were an investor, the economy was suffering, stocks suffered, there was no growth to be had. And last year, in about a month, a month to the year, somebody got the idea that this chat GPT thing was the coolest thing on earth, and it was going to be the solution to everything. And investors saw that there was growth possible, like not even happening, because you can't invest in chat GPT, but they piled into things that chat GPT and its friends can use. So that has been driving the market pretty much through the end of October, where the Fed came back in and said, hey, maybe we'll reduce rates, or implied that, or said maybe we're at the peak of rates, and that implies lower rates at some point in the future. So these are the weak points that investors glommed onto. So right now we're still coming off of that AI-enabled win for the largest tech stocks. But what's in the future? And it's at times like these where I love a good deal, I love a good bargain, and I am shopping and buying in those other areas and in tech as well, some of the less loved areas. And I think that's what I'd like people to take away from this kind of odd time where tech is king because it has the most likelihood of growth, which is probably true from here until we're all dead, because that's where productivity comes from, is technology. And companies will, pay for productivity. So I still think that there are values out there, and that you might want to go shopping in those other areas right now as we wind through earnings season. We're about halfway through, big week this week.
So-
I would agree with what Kim says. Technology is the future. It's where the growth is. It's just something that really every company needs. And I think that the rest of the market is a little more inclined to be more reactive, I would say, to really what those trends are in the underlying economy. So it gives us a bit more of an indication of how things are going. Last year was a good example, and Michael, I'm sure, has the numbers of, when you take those magnificent 7, 10, whatever they are out, the market, we didn't have a market that was as robust as what it would appear to be. It was still good. And so far this year, we've seen that broaden out a bit. So that makes us all feel a little bit better.
One
Yeah,
of the things that people have to be careful of in these kinds of markets, when you see the quote Magnificent Seven, which I guess is turning into the Magnificent Six these days, has got everybody's attention. But if you just think back merely maybe 25 years to the .com boom, there are a lot of companies that were booming. I'll name some: Global Crossing. What was the one that got all the publicity because they stole the money?
WorldCom.
WorldCom.
All right, WorldCom. All right, these companies were hot, and turns out, and they're gone. All right, nothing changed. The internet it didn't go away. I mean, it's become a major part of all of our lives. Of course, I mean, we're doing this over the internet, and so you have to be careful what you're doing here, because this is a ever-changing thing, and the companies are going to change.
All right, Michael, can you wrap it up for us?
Yeah, I'll be quick. I don't disagree with Kim and Carrie. The only thing I'd sort of push back on is I think tech stocks are just priced to perfection. But they've been priced to perfection for a while now, and they've pretty much been perfect. But I do think that the risk reward has deteriorated a little bit. The tech sector is very expensive and it has extremely elevated earnings expectations that might be difficult to achieve in 2024. So I just provide a little bit of caution there.
All right. Well, that's something we can talk about in the next session as well. I want to thank all of you for joining us. And there's a lot more to discuss as we go around the table to manage your portfolio. And we'll do that in the upcoming session. So once again, I want to thank Kim and Frank and Michael and Carrie for joining us. And I hope that you join us again for the next edition of Around the Table with Stacy Smith. Thanks for watching.